Today, folks, I am here to discuss boomer candy. What is that? People that chase super high yields, especially with this onslaught of option ETFs. They've been permeating my YouTube audience. I've been getting comments, questions in my chat group all over the place, and I wanted to reiterate my thoughts around this in this video. And we're going to talk about what my favorite option ETFs are and how I came to the conclusion that those would be the ones that I would buy if I wanted cash flow today. So if you're on a path to financial independence, as somebody that's been investing for over a decade that has outperformed the S&P 500 by leaps and bounds, let's do a comparable to any finfluencer clown out there. I'd be glad to consider subscribing because I'm on a path to financial independence. My goal is to get to financial independence sooner rather than later. I don't want to wait till I'm 65. I'm on track to be there by 35, and this is how I'm doing it. And even in that financial independent period, I'm still not going to be really focusing on this kind of investment strategy, and I'm going to explain to you why. So again, if you want to join me on that journey, go hit the subscribe button, folks, because I really want you to say it with me. Say it together. Here we go. Total returns over all else. Total returns are the end-all, be-all to investing. It is the benchmark of SPY, the S&P 500 ETF that mutual funds, hedge funds, any manager and individual stock investor at the end of the day has to own up and compare themselves to, because this is what literally takes no effort at all. You just put your money in this one thing, and to underperform it is embarrassing as an individual investor when you're putting all that time and effort in, and you could have just put it in here and walked away, right? And since inception, this has been around since 1993. The S&P's been around a lot longer, but since this ETF specifically that represents the market cap weighted S&P 500 is annualized 10.63%. 10.63%. Let's keep that in mind as we move forward. Over the last 5 years, it's been 16.5%, and the 3 years, 19.5%. We've been living in one of the greatest bull markets in human history, thanks to technology, the increase of margin and AI, and every sector going through these massive upgrades, right? This is what's led to these outsized returns. But I only own really two ETFs, as many of you are aware. I own VOO, which is the same as SPY. It just hasn't been around as long, and I wanted to really show you a more comparable long time frame. But I also buy VDY. VDY, till I motherfriggin' die, is my monthly Canadian income ETF. And no, it's not an option ETF, but I'm not just a dividend investor. I like the dividends. It's great, especially if the market takes a downturn. It's great getting a bit of cash flow to reinvest, but it's a very small position comparably. It's less than 20% of my portfolio, but this thing has annualized 10.2% over the last 5 years, 17%, the 1 year, 25%, and it has actually even outpaced the S&P 500 over the last year that's only been up 15%. So I've gotten a 10% extra return off VDY. Obviously, there's ebb and flow periods. This is a Canadian-oriented ETF, but this one has offered double-digit returns since it's been around, and that is what I am looking for, those total returns. And I've been messing around with the compound calculator as an example. So let's just say we can take the 10.63% return. We'll do 10.63%, and let's say you had 100 grand and you're 40 years old and you put it all in this ETF until you're 65, the S&P 500. You'd be left with $1.25 million roughly by the time you hit retirement. Now, I want you to keep that in the back of your mind. Even if you're in retirement, keep this in the back of your mind, because if you retired at 60, something tells me you're probably going to make it to 80, and you might want to see more returns that you can actualize into going on trips and buying cars and stuff my parents have done. But I'll touch on that toward the end of this video. So I want to reiterate what I talked about in my last option ETF video. You are a clown, you are an idiot, and you are a fool if you chase yield max. I do not like these ETFs. I feel like they're very depriving of actual returns. They're basically traps. They're dividend traps. They just try and pull investors in because they show off an incredible yield of 62%. TSLY was one of the earlier day ones that I think caught up a lot of investors, and this almost made sense if it was just going to go up and to the right. Now, a 62% dividend, if that was the total return for in perpetuity, I would quickly become a billionaire because I'd put all my money into this, because over the same 25 years, 62% would make me almost worth $20 million. But we know there's nothing that offers that kind of consistent return ever in the history of investing, ever. I mean, typically those lead to what we call bubbles in the market because nothing can grow at that pace. There's very few companies that can grow beyond, like, think Palantir's only growing at a 40%, but you're telling me your option strategy is going to annualize me more than Palantir's making in revenue growth? Come on, let's be real. So in NVDY, the NVDY, the yield maximizing ETF here has also become very attractive because it's down 25%, but has offered an 80% distribution rate. But again, since inception has been 74%. How has that been? Well, that's because NVIDIA has been doing nothing but going up and to the right. And if this ever stops, changes, or gets a little bit more volatile, something tells me your rate of return will likely shift just as much as Tesla's did. And I want you to keep in mind that you're paying a fat fee for this. You're paying a fat 1% fee. And again, I can show you the difference 1% makes. If you go back to our little formula here, and we were making that 10.6%, what if we cut that down to just 9.6% over that time frame? We're going to pay a 1% fee to go from 1.4 or 1.24 million to 989,000. That 1% is the difference between you being a millionaire or not. But you're saying, I don't care. I don't mind paying a fat 1% fee. I'm friggin' annualizing 74%. But let's look at the cumulative. The cumulative has been 229%. In the same time frame, if you just bought NVIDIA without thinking about collecting a yield, you would have been up 511% in the same time frame. You left almost 300% worth of gains on the table. Are you proud of yourself? I mean, the return is still great, don't get me wrong, but my God, you paid some guy 1% to lose out on 300% worth of gains. Now, MSTY is another one people are chasing because, again, things are great when they're going up into the right because I can get 76% in a distribution rate. Again, 196% since inception, 336% cumulative. But again, cumulatively, you've left almost 200% on the table. This thing's up 503% in the same time frame, guys. I just shake my head at the amount of return. Like, I think, what is that, 170 extra percent, 180 that you couldn't actualize because you were so caught up in collecting some cash flow that you so desperately thought you needed, where you could have just put a bit of an emergency fund aside, took the gamble on these stocks, which are incredibly risky as it is, and have done substantially better. I mean, even the best of best investors like Dumb Money, I mean, Chris Camillo, guys you might not have heard of, they lever up options so they can actually take this 500% and turn it into like 10,000%. Like, they're thinking in the way you should be if you're buying already risky investments and willing to use options against them. So I always revert back to things like British American Tobacco because I like businesses that are actually cash flowing. I'm talking about options, and most of you buying these don't even know how to write options, which is just as laughable that you're like just a sheep, you know, going right into the herd of wolves with no idea what you're even talking about when you're buying these, which is why most people should stick to actualized returns, dividends, not distributions that are coming from premiums of options, but rather stocks that generate cash flow, that earnings, you know, the earnings hit the books and they pay you out from the earnings, right? That are a little bit more consistent. I mean, look at like British American. This is something that I would focus on if I was a dividend and income oriented investor. My parents bought this in retirement, and over option ETFs, they've actually annualized an incredible return from the period they bought this at a great discount that have been comparable to the S&P 500, well annualized. I think they locked in like an 11% return or something like that. But again, if we go back and look at something like ULTY is another example here, one that I hear a lot about. ULTY, 84% yield, but since inception has annualized 5%. Thanks, Yield Max. You've done a fabulous job to the investing community out there. So let's talk about maybe more benchmark option ETFs, ones that write covered calls against perhaps like just, you know, broader index, you know, indexes like the NASDAQ 100, the S&P 500. Let's just see comparably what these returns look like. Again, I'm getting to the ones I think you should buy. Don't worry. Relax. Take it easy, guys. I'm just being a bit hyperbolic right now, but I think it's deserved for the lack of returns that these have offered investors. So QYLD, another popular one in the community. I like these a bit more. The expense ratios start to get much lower, which is nice to see. Still, the 12-month distribution rate, 14%, current rate's 11.6%. We look at those annualized returns since inception, 7.64%. You know the difference, the insanity of that. Firstly, let's just wipe out the 0.6% fee you're paying. By the way, on regular ETFs like the SPY, you're paying like 0.01%. It's non-existent. But you can say that 7.64 annualized, well, I'm only making 7 because they're taking 0.6 of the return anyways. So if we go back to our handy dandy calculator here and we just take a look at a 7% return, that takes us down to $500,000. That 100K now over that 25 years is only worth $542,000 versus what it should be worth at 1.24 million. I just want to let that sink in that you left 700 grand on the table because you thought cash flow mattered over anything else. So let's talk about XYLD, one against the S&P 500 here. XYLD has been around for a little while as well. You know, the expense ratio is still pretty low, 0.69%, or sorry, not 0.6 even, right? And we're talking about a distribution rate of 9.48%. Again, since inception, 7.51. Why are we even wasting our time here? Same, like, look at the Russell 2000. Is this any better? No. We know it's only worse. Yield since inception, 3.44%. Ooh, so exciting about these guys. I love options. Okay, let's kind of move on a little bit farther. So here's another one. This one again, and I want you to use this as an example of why short time frames are very deceptive. Most option ETFs that are becoming popular today have only existed in a time period where things are doing exceptionally well. As an example, the NVIDIA one, you know, the monster, you know, micro strategies, Michael Saylor to the moon, those things will never continually go up into the right like people are anticipating. The market just doesn't operate that way. We're in a bull market. It could last longer than you expect, but trust me, when those chickens come to roost, you might not be so happy with the rate of return thereafter. But if we look at something like this one as an example, that's only been around since September 2nd of 2022, honestly, during the bottoms almost of we came out of the interest rate cycle, that, you know, when they raised interest rates, the inflation cycle. So this has only been a bull market. And this, to give you an idea, again, yielding 12% right now. But if we take a look, and I think I had to, did I have to pull this one up on the fact sheet, or is it just down? I think it's just down here. Yeah. So basically, since return annualized, 13.43%, which is highly deceptive. The S&P 500 comparably 18.2%. So you've still left such a huge percentage on the table, even in the same time frame. There are no option ETFs that I've been able to find that can actually outperform the underlying assets. So let's look at ones that I think become a little bit more just. We'll start with the US ones and then talk about the Canadian ones for those looking for these and where I would buy them and why I would buy them. JEPI is a very popular one. It's been around since May 22nd, 2020. So just kind of coming out of the pandemic. It's been much more stable, but we'll start to notice, and I'm not going to get into strategies. If you don't understand covered calls, you shouldn't touch these in the first place. But most of these are just writing, you know, covered calls to collect premiums under the underlying assets to a certain degree. The ones that are writing less, you know, options against the underlying assets tend to make a lower yield, and that's what we're going to find. That this thing only has an expense ratio of 0.35, so we're playing in a very healthy expense ratio. I typically don't want to spend more than 0.3. 0.5 is like my max limit on a managed portfolio like this. 0.3 is incredible, but this thing only offers like a yield of about 8%, somewhere between 8 and 9%. And if we pull up the fact sheet, because to take a look at those annualized returns, this one since launch has been 11.68. The 5 year has been 11.61. So even over the last 5 years, let's say 11.61 against the S&P 500 over the 5 years, it's been 16.64. But since inception, you know, hasn't been around as long, coming out of the pandemic, but still, very great ETF, very comparable returns. I'd be happy with this overall. But what we're going to start to notice is a trend shift. Anything that can actually offer really good returns isn't going to be yielding 12 to 15%. Because again, even the S&P can't keep up with those over the long run, and there's no exception to that rule. Unless you're really crafty and very good at timing the market and individual stocks, which is something that I try and do with a percentage of my portfolio, the likelihood of these option ETFs performing over the very long run is slim. It's basically zero, right? It's zero as far as I can tell. So let's talk about one of my favorites. So that one's a good one. You know, JEPI's not bad. It's not bad at all. 8%, very reasonable. We're still getting a bit of equity growth here. But the one that I told my parents to buy, and the one that I would recommend, not as a financial advisor, just the influencer clown on the internet that's outperformed almost every influencer clown that exists out there, and I'll show my numbers if you're willing to show me yours. But DIVO is probably one of the best. It has one of the longest track records. It's been around since 2016. We've learned what it's like during periods of volatility, but it's not going to give you that yield you might want. But what I think is very fair, because we're talking about a total expense ratio of 0.56, a bit higher than I'd like to see, with a distribution of 4.73% paid monthly, which is great, but annualized 4.7 is probably more in line with a traditional ETF. However, I do like the underlying assets, which I haven't talked too much about with these ETFs, but this one's got great diversification. We can see that the return since inception has been 12.14%. The 5 year has been 14. I think the 5 year is better because, again, these haven't been around since 08 or the dot-com bubble, but 14% over the last 5 years. Comparably, the S&P has been 16.6. So we're getting much closer to what we've seen out of the S&P 500, which is something that I would applaud. And again, when you look at the diversity you're getting Meta, Apple, nothing making up more than 5%, Visa, JP Morgan. I love this ETF. I love what management's done. I think it's a very fair expense ratio, very diversified, reasonable options being written under the underlying assets to collect decent premiums, giving a higher than expected yield that you'd get off these, but still offering a great total return. It really checks a lot of boxes for me, but still underperforms, but you know, it's still fairly close. And as I've shown you, a 2%, you know, could make even 1% can make a massive difference over a long period of time. And I'll switch to the Canadian side because I know a lot of you want to see what I would buy with, you know, Canadian option ETFs, and I'm going to talk about when and how I would buy these. But again, I think I was talking about ZEB comparable to HMAX, because a lot of people like HMAX. This one's been yielding, like, I think it's been around 13%. Since inception, it's been 11.28%, but it's not really accurate because it hasn't been around that long. But if you look at the 1 year, it's been 26%. Writing options against Royal Bank, that's 23% of the holding here. You know, it's mostly just the banks, and they sprinkle in a little bit of Manulife and Intact, but most of this, 80% of this, is just banks. ZEB is just an equal weight bank ETF, has a much lower expense ratio, a much lower dividend yield of 3.68%, which might not get people that attractive. But when you look at the 1 year return of 37%, it has been outpacing HMAX by quite a considerable amount, by almost, you know, over 10%. So, you know, you don't want to leave 10% on the table just to collect a bit of a higher yield. I think it's and again, to pay a much higher fee that you do have to take into consideration here, right? And one, I do like HMAX. I do like HMAX, and I like HYLD. I think HYLD kind of is the best of all worlds, because basically it just said, hey, we're going to buy all the option ETFs that exist out there and basically just weight them, you know, in here just so you can get exposure to all of them. Since inception, 7.97. Again, if we look at we don't get a lot of track record here, but in the 3 year, 14.61%. Yeah, it's not terrible, but considering we got 19% from the S&P, it's quite a ways off. So again, I just really wanted to sink in, the guys, that all of these option ETFs will underperform the underlying assets. I would not make a total portfolio of option ETFs. I think that would be quite foolish to dominate options in your portfolio. But what I told my parents is, in their retirement, I said, hey, you guys have built this accumulated amount of wealth. Let's treat it with respect. Let's be a bit methodical here. I know you guys don't like to trade stocks because for some reason people have such a hard time hitting that sell button. I don't know why. They put so much research and effort. Think about this. They'll research for days, hours, weeks into option ETFs and dividend stocks, and they'll accumulate them over time and really formulate a whole portfolio just to underperform the S&P 500 because they're not willing to hit the sell button. You know how easy it is to just sell a few shares? If I'm up 19% annualized, again, this isn't cumulative, annualized. So in 1 year, if I'm up 10%, is it really a big deal to sell out 3 or 4% of your portfolio? No, it's not. But you might say to me, hey, Kyle, well, the market doesn't go up like that every year. And this is what I told my parents. Hey, if you're in retirement, if you need cash flow today, which already wipes out almost all of you watching this channel, because I know most of you don't need the cash flow today and you have an emergency fund. Let's look at, you know, dividend ETFs or general ETFs, the path of least resistance to security and wealth preservation that might yield somewhere between 2 to 5%. Let's find these ETFs, so your XEQTs, your VDYs, your XEIs of the world. Let's build a portfolio of these and figure out what your general income needs are. And let's get to your income needs first with very safe ETFs. Okay, once we've achieved your basic cost of living through safe, path of least resistance, wealth preservated, you know, funds, let's take the rest of the money and go look at two things: high yielding stocks and growth stocks. And we want to get a combination of both, because when the market's going bananas, those growth stocks are going to be very happy to have in your portfolio. And I would consider the S&P 500 a growth stock. And that's what my parents did. We bought some VFV, we bought some, you know, BTI, some of those growth or high yielding stocks. DIVO, I made them, you know, we bought DIVO because it's a great total return option ETF. Accumulated all of these together, guys, to get a good, well-rounded portfolio that isn't just focused on one thing, but with the extra cash. And that extra cash has yielded great results. My parents were even able to sell some VFV in this great market to buy a car, and they still have a ton of gain still below them. I mean, that's not hard. When the market does well, take profit. When the market doesn't do well, just live off the dividends or keep an emergency fund to ride the market for 1 or 2 years so you don't have to touch the portfolio. I will tell you, in my retirement, guys, I am not going to be dividend oriented at all. I'm looking at a total yield for my portfolio in retirement, which I'm not quite there now. I want to start rounding my portfolio off as I capitalize gains from, say, Google and some of these stocks that I'm playing in the midterm, the swing trades that usually last 1 to 3 years. But I'm going to be basically looking to get about a 2 to 3% yield in our total portfolio. I'm very happy with that because, you know, when you get up to $1 million portfolio, you're going to be getting somewhere between 20 and 30 grand a year. You know, that's enough to keep a roof over our head, perhaps a little bit of food on the table. But I'm a guy that just wants total return because I don't mind selling 1% of my portfolio to actualize some growth, right? And again, I really recommend playing around with this compound calculator because it should really help set in, you know, what those returns should be. Because if you're already at $1 million here, guys, let me add one more zero to that. If you're already at $1 million, and you're investing, let's say, for 5 years, and you get 10.6% over 5 years, that turns into 600 grand. 600 grand, guys, even on a 1 year basis, I mean, that's an extra $106,000 That's like crazy. So you're going to focus on a 4 or 5%, a 6% annualized return on $1 million just to collect cash flow, and you're going to leave 40, 50 grand on the table. Like, come on, guys. Like, just don't get diluted into the realm of dividends. I used to be that guy. A well-rounded, diverse portfolio should always be focused on cumulative return with a combination of growth and income. But I will pass that question off to you. I'd love to know what you think in that comment section below.